Welcome to another episode of Commercial Property Roadshow. You're here with Helen Tarrant. Today I'm actually going to talk about fair market value for commercial property. Now the market is extremely hot out there, and that's why this is such a trending topic about fair market value. Now you might be going out there, you're at an auction or you're at a close of an EOI and you're bidding against other buyers and you're wondering to know, what exactly is the fair market value? Am I paying above market? Am I paying below market? Look, everyone wants a bargain, right? Absolutely, everybody wants a bargain. But how do you ensure that you're not overpaying for a property rather than, underpaying for a property? I mean, we don't have problems if we're underpaying for a property, but we absolutely have an issue if we're overpaid for a property. And I can tell you a lot of people at auctions are overpaying for properties, and a lot of people are paying above asking price for property. Now, should you be doing that? What are some of the things you should consider when you are actually looking at the market? So, I want to cover off a few things. So fair market value is actually about 4 different points. So the first point is obviously I'm going to talk about the tenant. So the tenant. So that is about who is in the property. And the other one I'm going to talk about is the lease term. So how long is the lease and how that affects market value. The other thing I'm going to talk about is property type. So what kind of property are you buying in the commercial property space? So property type. And then, of course, I want to then cover off your tenant, your lease term, and property type. But the most important thing is location, as in where you are actually buying the property, right? So whether you're buying in metro or regional makes a big difference because people are actually trending more into regional now. And we've been in the regional market for really 5 years now. And so that makes us a real expert of seeing where the market was before, where it is now, and where you should actually be back. Should you be in regional? Should you be in metro? Now, let's go and have a look at this. For tenant, what are some of the things you need to look for? So depending on the tenant, right? So we have the idea of a tenant is it what I call a brand name tenant? Is it brand name tenant? Is it a stable tenant? Or is it basically your run-of-the-mill mum and dad tenant? Right? That is really the reason when we look at it, what it is, right? So you look at those brand name. We look at brand name, stable tenant, or mum and dad tenant. That affects your market yield or market return, and whether you're buying at a fair market price. The other thing is lease term. Is it 1 year? Is it 5 years? Is it 10 years? Is it 3 years? Like, how long is the lease term? And that really matters. And whether it is a net lease or a gross lease, right? So net lease or gross lease, how long is the term of the lease really matters. Property type, so that's whether it's warehouse, office, retail. What is it? What type of it? And that changes. And then location. So we're doing metro. And metro, are we talking Sydney, Melbourne, Brisbane? Or are we talking metro as in Cairns, WA, ACT, or we're talking South Australia? Which one are we talking in metro? Because that all changes as well. And then we're talking about regional. All right, so regional, are we talking regional in terms of regional as in large towns like a Rockhampton or a Townsville or even like fringes of Cairns, or we're talking like a Wagga or an Albury, or we're looking at the peninsula in Melbourne, or we're looking, where are we talking about in terms of regional, or we're more rural as in we're more inland, or are we talking more mining? So whereabouts does the regional sit? So all of those metrics, so you can see that when you're looking at fair market value, you're looking at 4 key factors. So the 4 key factors: tenant, lease, property type, and also location, right? 4 key factors. And then each of those factors actually break down to 3 and 4 categories. So when you're looking at the overall fair market value, you're looking at 12 to possibly 16 different changing metrics that you have to balance out in order for you to actually get the property at the fair market price. So for a non-expert, this is very hard. You have to literally sit and go through piles and piles of information to be able to grasp any one of those. And any one of those metrics change. It influences the whole dynamics of the deal. And that's why sometimes in a commercial deal, when you start out to when you end, it's totally different. So that's why you think, well, how the hell do I know should I be paying 2% for this property in terms of yield, or should I be paying 10%? And a lot of people are looking at mining towns at the moment and sending me deals and going, should I be buying in Chinchilla? Should I be buying in Mount Isa? Well, the thing is, Mount Isa and Chinchilla used to be 14%. They're probably in your location, your rural location. So if you get a brand name tenant in a rural location or a mining location like, Mount Isa or Chinchilla, and they are on 5 or 10 year stable tenancies, and the property type, let's say, is warehouse, the best type that people are looking for right now in this market, well, that's probably going to be an 8% yield right now. So that's where it changes. But however, let's say that it's the same property, but it's not the brand name tenant. So let's say you still get a 5-year lease, and it is still in Mount Isa or Chinchilla, so you're mining, it's still a warehouse tenant, but all of a sudden you've gone from a brand name tenant, which can be super cheap auto, or it can be any of those brand name type tenants like, Bow Repairs. You've changed all of that, and all of a sudden you have a tenant that is a possibly like a mum and dad, like say a mechanic shop that's going to give you a 5-year lease plus more, and they've been there for 10 or 15 years. Then all of a sudden you've gone from 8% yield to now should be paying 10 or 11% for that deal. Okay, so that change, just the change of tenant has changed the yield on that, and it's very hard to understand because most people can't grasp their head around it. So, but what happens if you have a brand name tenant like a Super Cheap Oak or Bow Repairs in somewhere like Chinchilla with the warehouse end, but all of a sudden they've got 2 more years to run on their lease. They don't no longer have your brand new 5-year lease, and they're an expiring lease. How much should you be paying for that? Well, the yield goes back up again because there's certain sort of levels, but it might not go up to 10 or 11%. It might go up to a 9% because you're paying for the risk of them not renewing and then having possibly a 12-month vacancy. But let's look at a scenario if it was in Metro. So right now, the most secure property that people are looking for in Metro and what they're paying, what they consider, or what I would consider a fair market value, is a warehouse property, which is trending between 5 to 5.5%, a brand name tenant, which then drops the yield once more. So let's just put it this way. Your warehouse property is probably sitting 5 to 5.5% right now. Your retail property is sitting around your 6.5s, possibly 7s if you're lucky, but 6.5s. Your office space sits one level above that, so it's trending is 7 to 7.5%, depending on where you're buying. But if you're buying 7.5% across the board in Metro, you're doing really well. But that's where it's trending. And of course, I'm talking about this is Queensland Metro. If you're in Sydney, you need to drop 1% yield down for every one of those. So your warehouse is 4.5%, your retail's 5.5%, your office space is 6.5%, and that's the same in Melbourne as well. But let's say this is Metro Brisbane. This is what you're looking for. Your 5.5%. It's your warehouse type property. So it's your warehouse with your run-of-the-mill, what we call stable tenants. So you've got your stable tenants in there, and then they might be, in the middle of a 3-year lease, right? That's your 5.5% stable tenant. 3-year lease, anything above that you're going to be paying for a yield. 5.5% tenant, that's stable tenant, on the middle of a 3-year lease to go, established tenant history in a good location that is a warehouse property around the Brisbane, Gold Coast, Sunshine Coast area. That's 5.5% every day of the week, right? Right now in this market. Now, changes that. Let's add some changes. So what happens? You have a brand name tenant comes in. So your mechanic goes or your trade tenant goes, and all of a sudden you have a national tenant that comes in, right? Brand name tenant, same 3-year lease. It goes from 5.5%, drops down to 4.5% because it's more security. More security, less returns. Just remember, more security, less returns. Less security, more returns. So that's what happens, right? And now all of a sudden the market is willing to pay 4.5%. That's your fair market value. Really, fair market value is really what someone is willing to pay for your property, what they're willing to pay for it, right? That's what people define it. But whether that is fair market value for you or not, that's an individual question that when we talk to our clients, we try to establish that value based on them as part of our strategy session and a part about building out their portfolio. But what market value is about what people are paying in the market, what they're willing to pay, what they perceive as value. And that's really different from what you would perceive as value. And that's where the conversation differs. Just because someone's willing to pay 5.5% or 4.5% for a property doesn't mean you will. Doesn't mean that I agree with it. Doesn't mean what I think is fair in terms of a long-term outlook on a property. So for you, we need to have that personal conversation. So that's why you need to reach out to me at helentarrant.com. But going back to this, so we go to 4.5%. Now, that's because you've got a brand name tenant, still 3 years to go, a very trending, warehouse property in a good location. Now, let's see that changes. That changes, and we go to the next level. So we go to the next level, and we now go to the fact that, you know, it's a brand name tenant, but all of a sudden they've got 1 year to go on their lease. Well, that goes back to 5.5%. So because of the less security, remember, less security, more return, more security, less return. Now let's just say that that it's now the property type has changed. Let's say we still have 3 years lease, we have a stable tenant, and all of a sudden it's not a warehouse property, it's a retail property. So it's a retail office, retail space, and it might be a cafe, it might be a restaurant, it might be, you know, a convenience store. It's just a retail space. All of a sudden that property is 6.5%. It's 6.5% because people are associating more risks with retail, so therefore you end up with more returns, right? So let's say that changes again. It goes to an office space. You might get a professional tenant, a lawyer, an accountant, a professional tenant. That's what we call a stable tenant. They go to an office space. It's a good location for an office space. They've got a 3-year lease. Market perceives that with the current COVID levels that it is not secure. So they want 7+ for that. 7+ is they want a premium because of their risk in this. So it's all about risk money, right? So in that sense, what happens now is that in order for you to get that deal, that's a 7%. So if you're chasing yield, that may be the right deal for you. And that is actually fair market value, because an accountant who's actually really, really stable in a property they've been there for 2 or 3 terms, having 3 years to go on the lease, you getting a 7%, that is a good deal. That is a deal we can write every single day of the week, and provided that we do all the due diligence, of course, on it as well. But let's say that changes. Let's say you have a metro property, right? You have an office space, right, which people perceive risky, right? So metro office, it's already a 7%. You have a stable tenant. This is your 7%. But all of a sudden, your tenant changes. Your tenant is no longer not only a stable tenant, they become a medical tenant. So you now have a medical tenant in there operating, and that could be a specialist, that could be a fertility clinic, that could be an allied health like a chiro or physio. It could be someone who imports, exports doctors or medical goods or equipment. All of those things. It becomes a medical tenant. Then the yield drops. So you drop from 7, you're now at 6 again, because more people are perceiving the tenant as secure. So they pay for it to have more security in the market. So there's so many metrics that moves. And one of the things you'll find is when you get into a commercial deal, sometimes as you do the due diligence, these metrics, those 12 to 14 or 16 metrics all changes, and you have to define what exactly is the deal and how you can cut the deal to make sure it's still equitable for you. And that's where most people make mistakes, stuff up, and walk away from a deal where they could restructure the deal. And that's where something that we actually specialize in what we do. But again, coming back to this, what if you change locations? So let's say that we are no longer in Metro Brisbane. We're going to be in Sydney, right? A Sydney office property is trending at 5.5%. Right? But all of a sudden you have a medical tenant in there. Now it's dropped to 4.5%. Purely because it is perceived as secure. So your key location, you're perceived as secure. So anything that is more secure than the average in the market, you pay for it by having less returns. Further, what if we move? What if we go to WA? What if we go to South Australia? Well, there's firstly less investors. Most people who are in Sydney, Melbourne prefer to either invest along the East Coast, so that's investing in their own backyard, so your Melbourne or Sydney, or further they go into Queensland, right? But if they had to go to WA or they had to go to South Australia, they feel like they should get a premium because they're actually investing out of their comfort zone. And when they're out of their comfort zone, they feel like they need to have a premium in order for them to do the deal. Because if you're buying a 6.5% or 7% yielding property in WA, well, you might as well buy a 6% or 5.5% in Sydney where they can be in their backyard and go and look at it. For most people, they will pay and hate that hit in that 0.5% rather than the other way around. So in order for you to work out what exactly is the yield, you've got to keep comparing it back. You've got to have a baseline. And this is what we do because we get to know the market so well because we do so many deals. We know what the baseline is. So when we see a good deal come through, we can tell our clients, okay, this is a good deal because these are what's trending in the market. This is how the metrics works. And this is how one metric changes. It changes the whole deal. And that's where you have to really be careful when you're out there looking on your own. One single metric changes, then it changes the whole deal. Sometimes people think, okay, I bought 2 streets away, and I'm getting 2% above what someone got within the main street. Well, yes, but you're also getting less rent in that area. Yes, less traffic flow. Yes, less suitable A-class tenants. So that affects the yielding. Yes, you should be getting more yield for that, or more return for your money for that, because you're not in the high streets or in the prime locations. So that is also something to really consider as well. So any of those metrics change, the deal changes, and you need to then renegotiate or reconsider and rerun the numbers and really sit there and think about it. So what we do during due diligence, we actually think a lot about the deal as we actually go through the due diligence. We actually get to know the property so intimately, and also our clients, and we know that at what point this is a doable deal. But then coming back to this, if we're going to be in WA, for example, and there's a 7% yielding property in Perth, right? And let's say it's a warehouse property, and I'm looking at that property, and might be, a 3-year lease to a stable tenant in a warehouse property at 7% in WA in Perth. I'm looking at that property, and one of my first thoughts are, all right, that might be what they're asking for. But if I'm going to be investing from a Sydney investor's point of view, or I might have a Melbourne investor, or I have a Brisbane investor, what is my risk, or what is my, basically, what's the risk money that I'm putting in there? So I would really need something to be more attractive than the 7% for me to invest in WA, because I could just take that same, let's say $1 million, and invest in my local backyard. So, if I, instead of 7%, I'll get 6% here in Brisbane, or I'll get 6% in the Gold Coast. And for me, that is more secure. And yes, there's a 1% difference, but there's another metrics at the back that we haven't considered, which is the back end growth of the property. So you're definitely going to get more growth on any of the things on the East Coast, bar probably South Australia, which is a little bit more flatter, and and some of the inland suburbs and regional, but you definitely generally get more growth in the east than you are in Western Australia. So therefore you will go, okay, well, I'm going to make up for the 1% in the back end anyway, so I might as well invest in the East Coast. And that's where you balance some of those things up. But of course, if you've got an 8 or 8.5% in Perth, definitely, or WA, you definitely consider it. Or if you get one in regional, you definitely consider it. And the same when you're in South Australia, again, you have to take into account, okay, so what kind of growth am I going to get in the back end of that? Along with my 14 or 16 or 12 metrics, and what am I growth going to get on the back end of that in comparison to what I'm getting in some of the major states, and would I be better off investing in those states? So there is actually a lot of data to process when you are looking at a deal. It's not just a straightforward look, finding a real commercial. That must be, if they're trending at 7%, that must be what fair market value, because there's a lot of vendors out there who's putting deals on the market because they're hoping someone will pay a premium for that, because they know it's a strong tenant and they know that someone will pay a premium. So really, when you are looking at deals, you need to look through the different metrics. Remember the 4, the tenant, the location, the lease, the property type. Then break that down into further 4 of each. So what type of tenant do you have? Brand name, franchise tenants, you've got your stable tenants, you've got your mum and dad tenants. So your unsophisticated tenant, your lease term, 1 year, 2 years, 3 years, 5 or 10. And also whether it's a gross lease or a net lease really matters, because some people, there is, if your strata goes up, then you're going to have less returns in the future. If your insurance goes up and your tenant's not paying for that, you might end up with less of that. There's buffering, and we work through that through a way of systemizingly work through whether the yield balances out the risk as well. Property type, should you be in warehouse? Is warehouse too flooded? I mean, at the moment we're having a horde of people investing in warehouses. For me personally, you don't have to invest in a warehouse to actually get the gains in the back end, because swings and roundabouts. In the future, in a little bit, where people get back to work and build the confidence, from really June next year, people are going to have a bit more confidence. Leasing's going to go up. You're going to find retail are going to come back, and retail's going to come back fairly strong. And then you're going to have offices on flow, and all of that. All those people who bought in now at a low period where people don't want to have that risk is going to get a significant kick in the back end. So you got to think about that as well. And then location. Where, in which state do you want to buy? Do you want to buy rural, metro, regional? And then that changes, because large regional towns demands a lower yield, more security, less risk, and then your normal rural towns. So you also got to think about that. So there's lots and lots of different things to actually think about when you're doing deals and working out what fair market value is. But just remember, you got to establish a base, and the base is usually stable tenant, 3 to 5 year lease, property type, whether it's warehouse, office, or retail. And then location. Once you establish the major ones, you get an understanding of it, and then you can go deeper into the metrics of how all of those things, and as they change, each of the things change. So again, I hope this has shown you that we're real experts in this marketplace in terms of commercial property. But one of the key things to remember is commercial property is not a trigger happy decision. You don't just go and go, yeah, I'm desperate to buy, and I just buy anything. It's not about that. It's actually about careful consideration, careful strategizing. Put the strategy in place, work out a plan for financial success and financial freedom, which is what we do every single day with our client. Build that plan, implement that plan, and we're here to guide you and help you and mentor you through that process so that you know you're doing it right. You're moving towards your goal rather than away from your goal. So hopefully that's helped you to understand a little bit about fair market value. If you want to reach out to us, and I really am keen to talk to you about how I can help you to achieve financial success through commercial property, reach out to me below, helentarrant.com, or click below to book in for a strategy session, or reach out to me at helen@commercialpropertycashflow.com.au. So until next time, keep hunting. Bye for now.